Apparel retail is going crazy today. We're going to dip into the full mailbag, but we're going to start with apparel retail because this is nuts. We've got two stocks and a spread of nearly 60 percentage points in terms of how they are doing today. And it's Stitch Fix and Ascena Retail Group. So we'll get to these one by one. Stitch Fix, first quarter profits came in much higher than expected. And nobody seems to care about that at all. Their active clients grew 22%. That was still a little bit lower than analysts were expecting. And then compounded by the fact that they come out and say, actually, we're not really going to grow that count in the second quarter. That appears to be what's hammering the stock, right? Because it can't be the profits. And they missed by a hair on the active client growth.
I mean, what world are we living in that our digital online fashion retailer's been hammered, but the classic, I guess, hard store retail location is doing well? But yeah, Stitch Fix is not done well today, to say the least. They announced earnings after close yesterday, and it was exactly like you mentioned, slower active client growth. So ultimately, while Stitch Fix has a lot of great things working for it in terms of the data, the inventory, the stylists, some loyal customers, they still need to sell clothes. And when you don't have growing, at least not meeting expectations in terms of active client growth, that doesn't bode well for your ability to sell clothes in the future. So it was that in combination with the fact that, that we're going into a holiday season, and management said we don't really expect to see growth as a result of the holiday season. A little bit understandable. I'm not sure who is gifting clothes. I think more people subscribe to this as a service for themselves versus as a gift. So that wasn't quite unexpected for me, but for a lot of investors, it did not paint a pretty picture.
No, I agree with that in terms of what should be expected around the holiday quarter. That being said, I'm pretty sure that on the docket for 2019 is some sort of plan around the holidays to gift subscriptions to sort of get new people trying, because people who subscribe, they hate that word. Stitch Fix, they hate that whenever you say it's not a subscription service. Okay, fine. But people who use this service really love it. And so that would seem like a natural way to sort of, if they can figure out a way to enable the people who use the service and love it to give it as a gift next holiday season, that would bode well for them. I shouldn't pick so much on sort of the Wall Street analyst expectations as a group, because as you point out, this is a growth stock. And if they're not growing, they're going to get hammered for it. That being the case, this is a stock that is down about 30% today. It is trading for $18 a share and change. 3 months ago, it was over $50 a share. Is this a buying opportunity for Stitch Fix? Because this really seems like one heck of a sell-off in just 3 months' time.
So I've said this before. I spent a lot of time thinking about Stitch Fix. And I think the reason why we see such drastic changes, right? $50, $18. I mean, those are huge differences in price. I think that's because Stitch Fix is a binary stock. This stock is either going to succeed or it's going to turn into Blue Apron, right? So there really is very little room for a middle ground when it comes to Stitch Fix. So when they do not meet the expectations of a growth stock, the first thing that jumps into investors' minds are, this is a 0, not a 1. This is not ending up well on the binary scale for me, so I'm selling off because it's going to nothing. Versus other stocks, when you have bad quarters, I think a lot of times people think, oh, it's just a bump, it's going to slowly grow. This is a company that's either going to make it or fail in a lot of investors' minds. So, I mean, if you're one of those people that really loves the service, really believes in their ability to attract people, to retain customers over the long term, sell that data to get people to buy more clothes, I mean, this is an amazing buying opportunity. And I know a lot of analysts here at The Motley Fool support Stitch Fix, love Stitch Fix, and I'm sure they're seeing this as a buying opportunity. But I also know that personally, myself, and I know other analysts disagree, because it's a binary stock. So I think ultimately it really just depends on which side of the fence you fall on.
Is that because, is your feeling about Stitch Fix, is that personal about Stitch Fix, or is that the way you feel about binary stocks in general? That you're just as an investor, you're not interested in binary stocks?
I would argue that I'm less interested in binary stocks than some people. I don't think that's an immediate deal breaker for me. For me, Stitch Fix, I mean, granted, I'm not quite their target customer. I don't spend a lot of money on clothes. I just didn't see it. I didn't see them retaining users for a long time. I reserve the right to be totally wrong about that. In fact, we talked about giving it as a gift. I hope my mom doesn't listen to this podcast because I actually got her a Stitch Fix gift card for Christmas with the intention of kind of experimenting on somebody who does value convenience over price and would love to get clothes in the mail. So we'll see if she ends up retaining her.
So they do have a gifting program.
Well, they have the ability to send a gift card, which to me is not the best gift, right? Whenever somebody opens it up, it doesn't have that same kind of exciting feel. You just got a gift card. I think if they were able to implement something where I was able to send her first fix, then maybe that would be more appealing for people as a gift. But some of that's too just awareness. I'm not sure if people are aware that Stitch Fix could be a present. So it'll be interesting to see what they do next year.
Here's what's going in the other direction today. It's shares of Ascena Retail Group, which is the parent company of Ann Taylor, Lane Bryant, Loft, Justice, and the unfortunately named Dress Barn. And as we were talking about right before we started taping, thank God that at some point because Dress Barn used to be the name of the company, and thank God they changed it to Ascena Retail. Help me understand this. This is a stock that's up about 25% today. I get they did better than expected. Same-store sales were up 3%, which is not huge, but the expectation was for half that. So what's driving shares of Ascena Retail? Is it simply this thing's been beaten down for so long that we're all stunned that they did as well as they did?
That's exactly it. I think everybody has forgotten about Ascena Retail, and then they come out with this earnings beat way better than expectations, and people are like, oh, this company still has a pulse. I don't think that makes it necessarily a great buying opportunity, but just the fact that they are not directly going under made investors realize, hey, maybe retail space isn't as doomed as we thought. But I do think it's important to look at the differences between their different brands and how they performed, because there are stark differences. The benefits really came from the premium and the kids segment. So that's Loft brand, Ann Taylor, Justice for Kids. These are the segments that really saw that growth. And then virtually all their other segments declined. So Justice up 12% for same-store sales. I mean, that's insane. So I think for them, it's going to be really just kind of picking out what's succeeding, what's not succeeding, and relying on those brands to drive growth in the future.
Over the past year, the delta between these two stocks is nearly 100%.
In the same industry.
It's the same industry. They're both selling clothes. Stitch Fix shares down about a little more than 20% over the past year. Ascena Retail up more than 70%. This is bananas. I look at this and I wonder, particularly in the case of Ascena Retail, okay, they've got all these brands under the umbrella. Should they be getting rid of? I mean, you're not the first person. Because I mentioned that over the weekend, took my son shoe shopping, and the place we went to right next door was a Dress Barn. And you're the second person today who I've said that to, and the reaction, the words out of your mouth were, I didn't even know those were still around.
I think they could drop Dress Barn, and I don't think anyone would notice.
Well, that's the thing. I look at that and go, okay, if you're looking at Justice and putting up double-digit comps, I mean, clearly, if they're doing 12% comps, clearly Dress Barn and some of the others are dragging them down.
Of course. And it's so interesting. And it's a hard kind of segment to wrap my head around sometimes, because retail within itself, I've mentioned this before on the same podcast, but I think we have premium and I think we have cheap now. That middle ground where Ascena Retail, a lot of their brands play, that's more challenging. And you'll notice that, Loft, which posted 9% comp, also posted an increase in the average selling price of their clothes. So they were raising the price of their clothes and then having to decrease the price of their kind of cheaper brands, and that increased their sales. So I think that might be a testament to the fact that, people like Stitch Fix, they're willing to pay a little bit more for premium clothes, or they're going and getting, very, very cheap discount clothes for what they're not buying premium. I wonder if that middle ground is going to exist.